Hello and good afternoon, everybody. I am Tim Immel with Beckstone Partners. Very, very, very excited for today's webinar. We have a fantastic guest, a guest that I have known for close to over 8 years. Chris and I have known each other, done business together, and he is going to speak today about one specific growth emerging market. But I'm going to go through here and highlight a little bit about Beckstone. After Chris is on, Chris is a very, very busy individual. I'm going to get Chris his time here at the front, and then if you guys would all like to stay on and learn more about what Beckstone's product is, what we're showing here, we're going to talk about our product in the allocated inventory to this specific unbelievable market that Chris and I are going to attest to and show you facts today. So again, Beckstone Partners, we are a solutions-based organization. We offer the ultimate solution for IRS compliant self-directed investors. And then look at this here. We're constantly monitoring ancillary tertiary markets throughout the United States. And Chris is going to speak about why we stick to the ancillary and tertiary markets. We're going to talk about how major metro markets actually feed these markets. Of course, if some of you may know, one of the huge hits that I've had in my career is tracking this Panama Canal expansion and what it can do to not only impact markets, which Chris and I have been involved with since 2011, but how the markets that we're in today, how the flow, how it kind of ebb and flows right into this location that we're in. And take the Panama Canal expansion aside and the Port of Virginia aside, that's a compensating factor, ladies and gentlemen. But what we're going to talk about today is about this niche market that you probably never heard about if you're new to us. But it is one thing that we've never said before. So Chris, thanks again for your time. I really, really appreciate you taking your time and your team's time to put this together to join us today. This is going to be a webinar that hundreds, if not thousands, of people are going to enjoy. So you're on the main stage, Christopher, and if you want to attest to yourself, please brag. Talk about what you've done, and talk about your background at from growing up and going to Maryland and everything that you've done. And go for it, buddy.
Yeah, well, hey, thank you very much, Tim, for the intro. I greatly appreciate it. Just give you a little bit of background on myself. I'm a Baltimore boy, born and raised. I started in commercial real estate in November of 2006 after working for what is now actually the largest property management company in the country, Bozzuto Management Company. So my entire life has been in apartments. And when I started selling apartment buildings in November of 2006, I thought it was awesome. And then really quickly around October of 2008, I was like, oh man, I think I might have screwed up. And the solution for me at the time, all of my business dealings, in the first year and a half of my career were all centered around DC. And what happened when the economy collapsed was, the sellers that could transact and were transacting in DC were happy to do so. But because pricing was still way, way askewed and there was no yield to be had, I consistently got the story from sellers, hey, look, we're happy to sell at these numbers, but there's no way we're ever going to buy at these numbers. And so in 2008, I moved my business to Richmond, Virginia. And I moved my business to Richmond because I looked at the two closest strong secondary markets to DC that I thought I could bring DC capital to. Obviously, being from Baltimore, my initial thought was, well, hey, I'll bring all this money to Baltimore because I know Baltimore like the back of my hand. I grew up there. This is great. The only problem is that my manager at the time advised me, look at the fundamentals of the market before you make a jump like that. If you're going to dedicate your business to a specific region, you need to make sure that the fundamentals of the market support what you're going to do. And so I took his advice, and at the time, and this is 2008, Richmond had much stronger fundamentals than Baltimore for two specific reasons. The The main one was the, kind of in-place employment drivers that were, embedded in that market and would never yield. Mainly colleges and universities. So, Richmond, you have University of Richmond, MCV, which is Medical College of Virginia, and VCU, a total of about 45,000 students. And it is a major driver of the town. Secondly, it is a state seat, so it's a state capital, so you're always going to have a government presence. And even though some of the big businesses like CarMax and, Wachovia obviously was no longer, and Wells ended up moving down to North Carolina, we lost a lot of our big, Fortune 500 companies, but still had the core of, the drivers of the market. And, between 2008 and 2018, I saw Richmond, Virginia pop. And, I like to say that I had a hand in it. A lot of it had nothing to do with me. It was just purely the market drivers. But I saw, your average cap rate in downtown Richmond. So we're talking, your core downtown area, VCU proper, were the places that you want to be. I saw your average cap rate go from, if you were able to sell a 7 cap in Richmond in 2008, you were a wizard. So now, 5 caps are consistently what we saw in downtown Richmond. We saw your average price per unit go from, and again, for all comparable product, $85,000 a door to, the last deal we sold at $178,000 a door for the same stuff. So, when you look at why, that's happened and why a market would appreciate in that kind of manner, you have to break it down to fundamentals. And, we're numbers guys. And so when we look at, penetrating a new market and figuring out which one of the markets that we can conceivably bring, DC capital to, my opinion is I can sell anything within a 3-hour radius of DC if I can tell the right story. And so what we do is we look at fundamentals, and the fundamentals of the market that we look for are all based on demographic information. So, our newest venture with Beckstone has been, our first venture with Beckstone was focused predominantly in Hampton Roads, Virginia. Hampton Roads is a great market. As Tim was saying, the Panama Canal expansion and, the pure driver of, the U.S. military of that market makes it a really strong, stable market. And, we timed the jump right, and, the people that invest in those properties have done very well on both a general appreciation basis and also a rent growth appreciation, because those two don't always coincide. More often than not, in your major markets, you'll see more real estate appreciation than you will rent growth appreciation.
Right. Chris, would you say, and if you don't mind, what we talk about all the time is, Chris and I probably speak 25 times a week, and at the end of the day, the reason, would you say, for those major metros hitting that appreciation rather than rents is pretty economics 101. It's, the rents are going to trail in arrears. If you start with a $100,000 property at $1,000 rent, obviously your rent has a contract, right, anywhere between 12 and 24 months. So that figure is locked in. But what can happen in the market if we time it right, like,
and so that's the crux of what we've seen over the last, call it 10 years. So in 4 months, we will have seen the longest period of time in U.S. history without a recession. That's going to hit in 4 months. So basically, we've artificially propped up the economy over the last 10 years to avoid, you had the 2010, 2012, CMBS bubble that we, Greenspan artificially said, hey, we're just going to bring interest rates down to zero, and that'll solve this problem. Because if people had to refinance their loans, given their current cash flow and debt service, at debt service coverage ratios, at that time in the market, they'd have been crushed if the interest rates that they were going to refinance at even remotely resembled the interest rates that they had gone under at originally. So the challenge in your primary markets goes to what I call the affordability matrix. And, what we base that on in the apartment world is cost of living as a percentage of area median income. So if you look at a market like Washington, D.C., or even Baltimore, the area median income in Washington, D.C., we'll just for ease purposes call it $100,000. It's a little bit more than that, but for the purpose of this conversation, we'll call it $100,000. The area median rent or AMI rent is 160% of the area median income. So that means that in order for someone to live within what HUD deems as, the right ratio of income to housing expense, deemed by HUD is 35%. So when you talk about, percentage of AMI or rent as a percentage of AMI, what we use is a 35% ratio if you're talking apples to apples amongst, major metro markets. So in DC, the rent per AMI to reach that 35% threshold is 160%, which means that in order for you to live comfortably in DC proper, you have to make $160,000 a year. That's a lot of money. At the same time, you have the burden of development. And I say the burden of development because in a hot market, developers do what developers know how to do, which is build. That's how they make money. And if money is liquid and someone will finance their project, it doesn't matter if it's a good project or a bad project, that developer will build it. So what happens in primary markets, and this is what we're seeing now in areas like DC and Baltimore, where your rent per AMI is substantially higher than the area median income, you get into an affordability complex. And as new buildings are being built and delivered, it's putting a glut of units on the market. Now these units, the builders and developers of these have already built in, lease up concessions and everything else, so that what will happen is you might have a one bedroom that has a market rent of $1,700, but because you're getting 2 months free and the owner is letting you amortize that over the 12-month term of the lease, now your $1,700 rent turns into an $1,150 rent. And what happens is that now the owners of properties in that B space, that their one bedroom tenants are paying $1,100 a month for their kind of crappy one bedroom with no amenities. Like, it's fine, it's clean, it works, but it doesn't have a gym, it doesn't have a pool, it doesn't have a cyber lounge, or it doesn't have any of the cool stuff that the new stuff has. But now this same tenant, provided they're a viable tenant and can pay the rent, is going to go to that new building. Because why not? It's the same money, and I've got a much better quality of life. Now that same tenant is very likely to move out in year 2 when the landlord can no longer support the steep concession. They'll just move out and they'll move back to their place. But it's caused a huge disruption in your primary markets, because in all primary markets, we are now overbuilt. There's a couple of exceptions across the country, but they are few and far between. And mainly the exceptions to that are going to be markets, like San Francisco, New York, places, Seattle, where, development has really been curtailed vis-a-vis really, really strict, essentially public welfare housing programs in which a certain amount of the amount of units that have to be designated on a steep affordability matrix makes it prohibitively, it makes it really challenging to build. But outside of those markets, in every major market, we're overbuilt. So the question is, where can I feel safe, right? People invest in primary markets because, Philadelphia, Pennsylvania, Washington, D.C., Baltimore, Maryland, Los Angeles, California. And even if you're not from there, you can still piece together some semblance of what that market feels like, just because we all know them. I mean, these are primary markets throughout the country. So what we're focusing on today is, basically what my whole, model has been in commercial real estate, which is, let me find the best secondary and tertiary markets in relatively close proximity to well-established, good primary markets, and use that as a way to establish yield for my clients. And in this case, Beckstone and everybody Beckstone works with, I consider to be my clients. So, in my fiduciary responsibility to Beckstone, I want to vet and create the best market opportunities for their clients.
Very good, Chris. Well, you want to introduce that market, that gem that
Yeah.
we found,
So the little
and
gem we're talking about.
one quick thing, Chris. Let's attest. When I speak and I talk to our investors and educate them on this, it's not like we jumped into this market. It was, it was 14 months that we spent underwriting, uh, negotiating, getting our lenders involved, getting multiple lenders involved in this case.
And that was 14 months we spent on it. There was an additional, 6 to 8 before I even brought it up to you guys. That
Right.
hey, this is something I think might fit, for the model. Let's look at this. Let's try and get some deals together. But, this started with me hiring a guy that I didn't know where to put, and I looked at kind of that central PA corridor and was like, well, why aren't we doing any business there? There's apartments there, and it's within a commutable distance to the markets that we're heavily, engaged in.
Right.
So yeah, even still, I mean, so even before we brought it to you, there was still, a good amount of research that went into,
Oh,
is it worth deploying somebody into this part of the world?
all right. So you want me to get into your fact slides and a little bit about
Yeah.
it?
So real quick, so the first slide here, this is just a little bit about Lancaster County, Pennsylvania. Um, Again, Lancaster County is call it Dutch country, Pennsylvania. Um, it's a very stable, static market. Obviously very historic, founded in 1729. Kind of sleepy large. You're a little bit over 500,000 people, so it's not a small county by any stretch of the imagination. And again, here as we talk about drivers and things, points of interest, um, we do have a good amount of colleges and universities in this area. Again, none of these are giant schools. Most of them are in the 3 to 5,000 student range. But I've always been a big fan of, if you're going to have a smaller secondary or tertiary market, having a college, let alone 3 or 4 as a part of that, is always a good thing. In addition to that, you've got some entertainment things, Dutch Wonderland, Strasbourg, Hershey Park, Longwood Gardens. Lancaster County, Pennsylvania is also, it's part of the chip capital of the country. So your
Snack food
first,
capital of the world.
I'm sorry?
Snack food capital of the world, they call it.
Yeah, exactly. Exactly. So again, we've got a nice static little market. It's established. It's been here since 1729. And so now we're going to go into the next page, which is what makes this market interesting. So when we look at demographic data, what we look at is basically these specific indicators. And this was taken straight from, U.S. Census Bureau website. If you Google U.S. Census Bureau, or if you just Google demographics of Lancaster County, Pennsylvania, it'll take you first to the Census Bureau site and all of this information. There's a lot more that's contained on the page, but these are the items that we focus on. So, I would say that, I'll tell you why, and these are the items that we're focusing on. So, first one is population. Again, we have a nice sized population, over 500,000 people. It's established. It's not going anywhere. The other big indicator is your population growth since 2010. If you look at the trends in secondary markets throughout the country, there's been what we'll call a reurbanization of the United States over the last 10 years. People started leaving the suburbs and moving back into the cities. Now, you can blame a lot of this on a function of traffic, or affordability, because all of a sudden the suburbs became just as expensive as the city. So why am I going to live in the suburbs and commute an hour and a half if I don't have kids and don't need a yard and whatever else? And amongst that too, the new generation, millennials, they like a more urban environment. They want to eat, live, work, play in the same place. If they didn't have to have a car, they wouldn't. And in a lot of cases they haven't. So that's caused a reurbanization. So the fact that we've got a very, kind of, call it suburban market. Now, granted, it's not necessarily a suburb of any specific city. it's kind of its own little entity. But nonetheless, the fact that it's had 4.6% population growth since 2010 is a really strong indicator. In this market, we have 212,205 housing units for a little over 500,000 people. 68.2% of these are owner-occupied. So what this means is that only 30% of this market is rentals, which is great because that means that we have a captive renter pool. So as real estate investors, as multifamily investors, we have to look at what our absorption risk is between the existing stock and new units coming online. So the fact that 68.2% of the people in this market own is phenomenal. Then you look at your median household income, $61,492. That's about $5,000 over the U.S. Average. Median home price of $193,200. That's a nice, healthy home price. So, if you guys happen to be looking at, some of the properties that we have in these markets right now, you'll see that they're priced very much in line with these area median prices. This is where we really get into the interesting components of what makes this market attractive. So your median monthly housing cost is $1,482. So this is somebody who's owning, paying a mortgage, paying insurance. Their median monthly housing cost is $1,482, and then we're getting a median gross rent of $957. And these are two important components. And now we've also only got 1,436 building permits for the purpose of multifamily or any kind of dwelling. So this is all of your houses, all of your apartment buildings, all of your anything housing related in the market. There's only been 1,436, which is a very small number commensurate to the number of households that you have. Your average people per household is 2.64%, and your same home, people who've been in the same home for over a year is 88.4. So the reason why these are important numbers is if you're looking at a market, it's a stable growing population, which is challenging to find in some of these secondary areas. I mean, you go to a similar spot in Ohio and you're going to see population contraction.
How about this, Chris? Des Moines, Iowa.
Des Moines, Iowa, exactly.
Des Moines, Iowa is the exact same size of population, right? And unemployment rate in the greater Lancaster area is right at that 2% number, right below it, a hair below underneath each, which I would say those people are professionally unemployed. At the end of the day, what we're seeing and what you've illustrated to us, not only on this call, but today, is that indicator is just yelling jobs, right?
It is. So actually, on the subject of that, I don't know if you know this, but the lowest unemployment rate in the country right now is actually in Ames, Iowa, which is right down the road from you, about 40 minutes outside.
That's where I went to college. You know that.
Well, congratulations. You guys have the lowest unemployment rate in the country. But moving on. So obviously you need a stable growing population. The second thing is affordability, because when you're investing in a secondary and tertiary market, it's really important that you don't overpay, because the people that are renting and owning these places have a fairly fixed income, and their income's predictable, it's ready, the employment drivers are stable, so you're not going to have the major collapses in employment and things like that. But you need to make sure that you're sticking to the affordability matrix. So again, if HUD says 35%, and that's across the nation that we're going to use, if you see here, and I apologize that the type's a little bit smaller, but your average rent as a percentage of area median income in Lancaster County is 18.6. Again, we're almost half of what HUD feels is the healthy threshold. So that means we've got room for rent growth, right? If people are only spending 18.6% of their income in rent, and 70% of the market, or I'm sorry, 84% of the market is owners, then or I'm sorry, 68, it was 70, are owners, then that's you're going to have room for rent growth. You're not going to be constricted by people not being able to afford your rent increases. Should you decide, hey, I want to increase my rent $50 a month, and I know that there's nobody else or nowhere else you're going to go, so you're kind of stuck, and you can do that. And as a landlord, that's what you want. And on the flip side too, and again, because of the model that Beckstone employs, you also want to make sure that your retail out sales, that you still have that cushion in your retail out sales. So again, right now, on a percentage of AMI on your total housing cost, you're only at 24%. So you've got a lot of room to both grow rents and grow per unit housing costs before you, and that's assuming that income stays completely flat, which it's not going to. Obviously, income's going to increase as inflation increases, but assuming income stays flat, people still have a lot of room to still be able to afford their mortgage or their rent in these markets. And the other one that's huge, as a landlord, the biggest expense that you're going to incur is turnover. So the fact that 88.4% of people in this market have lived in their residence for over a year means that generally the way we underwrite is about 33% of a property turning over a year. And if you use $600 per unit as your turnover cost, just to clean the carpets and do paint, anything else you're going to charge the tenant, but you're saving a ton of money by only having to turn over 22% of your property. It's huge, and people underestimate that. Or I'm sorry, 12 people underestimate that a lot. So the low turnover is also big. So the next thing we did is look at, so we talked about previously, what is my closest primary market to the secondary market that I'm in, and how do the fundamentals compare between the two. So what we did is, on the next slide, we did an analysis between Lancaster County, Pennsylvania, and Philadelphia. Everybody knows Philadelphia. So on a population size, Philadelphia city, and this is city of, not counties, this is Philadelphia proper, is roughly 3 times larger than Lancaster County. Lancaster had a growth of 4.6% over the last 10 years. Philadelphia only had a growth of 3.8. We have 212,000 and a little bit over that housing units. The U.S. Census data didn't know how many housing units the city of Philadelphia had, which is concerning. And the reason for that is as in big cities, you have so much turnover in terms of blighted properties that get condemned and destroyed versus new builds and new starts and whatever. It's really hard to pinpoint the number of housing units in any major primary market in the United States, which is scary for a reason that we'll encounter down here towards the end. So we've got 68.2% owner-occupied in Lancaster versus 52 and Philadelphia. Median household income in Lancaster, Pennsylvania, is $61,492. Almost, you call it $20,000 higher than the median income in Philadelphia, which is challenging because the general cost of living in Philadelphia is much higher than it is in Dutch country, Pennsylvania. Median home price, again, you're talking $193,200 in Lancaster versus $151 in Philadelphia. Now, that's also skewed by the fact that this is taking into account all of the blighted property that's currently on the books in the city. So the way the Census Bureau pulls this data is by tax records. So they look at the tax assessments for all of the houses in the municipality that they're analyzing, and it all gets blended together. So your burnt out shells that are assessed at $20,000-$30,000 a door, and you've got blocks of these things, are also being weighed against your kind of nice run-of-the-mill middle class stick-built housing, which is very prevalent throughout all of Lancaster. The other big one, so here again, your median rent, even though people make $20,000 less, your rent in Philadelphia is $13 higher on average, which also takes into account all of the affordable housing, project-based, everything else in that market. So that 970 is a very skewed number. I do think that the 957, from everything we've seen, is pretty actual in Lancaster County, but if you were to take all of the designated affordable housing out of this rent matrix in Philadelphia, you'd probably be closer to like a $1,200 to $1,300 average rent, but still the average income of $40,000. And then building permits, again, the fact that we don't know how many housing units there are, and we also don't know how many building permits have been issued, is problematic because what it does is it creates issues of absorption. Same thing that's happening in Washington, D.C., same thing that's happening in Baltimore right now, where you're seeing your B-class product having rent compression because of artificial rent compression caused by new A-class product. It creates an unbalanced, unhealthy rental market. And then other than that, we've got same average people per household, basically. Same amount of people in the house for a year. The area, again, from an affordability standpoint, where this gets hairy, comes down here in these last two lines. So we've already discussed that our rent per AMI in Lancaster County is 18.6. In Philadelphia, you're 28.6. Now that means by HUD standards, you've only got, call it 6.5% that you can go up before you start hitting that ceiling of affordability. And then your average housing cost as a percentage of AMI, you're at 31.2. So your rent growth and housing growth, again, everything being equal and staying in a healthy market in which things are not overpriced, you only have, call it 4% on the purchase side in Philadelphia and 6.5% on rent side in Philadelphia versus almost twice that in Lancaster across the board. So, if you're looking at it, and again, this is why we're here. We don't expect people to do the research on why Lancaster County, Pennsylvania, as opposed to Philadelphia. That's our job. But the fact is we go into, before we're going to deploy an agent that is going to be dedicated to a market and whose income is dependent on being able to be transactional in a market, we do a lot of upfront work to make sure that market's going to be viable and fruitful. And this is how we do it. So if you go to the next slide, your fundamentals to investing in secondary markets are very simple. Know the market fundamentals. Pull the census data. It'll all be right there, and as long as you use the 35% of area median income number as kind of your effective affordability range for market rents, and you pay attention to existing inventory, new starts or permits issued, that's good. Second is focused on affordability and demand. So if you're in a market that's not affordable and the population of that market's declining, you don't want to invest in that market. It is very, very detrimental to invest in a market, and everybody's doing it as we speak. I mean, there are people beating down their doors to get property in Washington, D.C. right now. I'm not really sure why, but I know they're not focusing on affordability and demand, which, again, the people that are paying top of the market right now at the very peak of the market are going to get burned when the market contracts. Make sure your market is growing, not shrinking. Obviously, you want people coming in because people equal buyers, renters, and revenue. And then compare market fundamentals to a nearby market. That's it. And if you do those things over the years, I believe, in my experience, you'll have done your due diligence and being able to smartly invest in secondary and tertiary markets.
Now, Chris, a few questions for you. And you speak about, a bust coming. Do you see that I see it in retail, writings on the wall, obviously, Amazon of the world. I think those C-class townhomes, not townhomes, excuse me, strip malls and stuff like that, I foresee, with the population growth of the entire world in the United States, I see those as the next developmental property, in which is going to bring that life back to community, but in those urban or developed where there's mature trees, where there's life, there's community already established, and by removing a strip mall and developing, whether it's residential homes or apartments or condos, whatever it is, do you see that as being the first target? Because obviously we all see strip malls wherever we are in the United States, those C-class ones built in the 80s or the 70s or early 90s that have, for lease signs on 50% of their asset. Do you see that as the bust? And question two is if there is a bust, do you see it? I mean, especially in the Northeast, where of course there's a huge volume of money, and there is, yes, those trophy assets, those Manhattan assets, those Philly assets. Do you see these ancillary and tertiary secondary markets busting out with employment as low, unemployment as low as it is?
So here's the thing, and not to cut you off, but to kind of talk, I would answer that question in a couple fold. So yeah, I do think that you're going to see. I think your biggest compression in the markets is not going to necessarily be your 70s, 60s, 70s strip malls, because again, rents are cheap in those, and I think that, for your hairdressers, your barbers, your, little Edward Jones accounting office, whatever. I mean, it's got street frontage, it's got foot traffic, and yeah, you might be experiencing some vacancy right now, and I think that the reason you're experiencing the vacancy right now is because a lot of your larger, bigger box centers, that used to have a Kmart or a Barnes and Noble or something like that as the anchor tenant, now those spaces are being split up into much smaller spaces, and the smaller inline spaces in those centers, so it's the same thing that's happening in Class A apartments right now, versus Class B and Class C apartments, where you're seeing, major development that's sucking wind, giving concessions enough so that now, that barber shop that could only afford to pay X amount of rent and be in a crappy little 80s center, can now be in a nice center that used to have a Barnes and Noble in it.
Right.
So I think you're going to see that. As it relates to the security of the East Coast from a housing standpoint, it is as secure as it has ever been, I would say ever. So if you look at what's going on the West Coast right now, there's a petition. It passed in Oregon. It did not pass in Washington or California, but it's called Prop 101. And basically what they're trying to do is turn the entire West Coast into a rent control entity. So our firm was founded in Encino, California in 1979. And our original model was to move capital throughout the California market, so that a guy who's selling an apartment building in LA at a 3 cap would have someplace to go buy another building at a 7 cap. And again, these are using today's matrices, not back in the 70s. But this new rent control petition that is literally in every state on the West Coast is killing the housing market on the entire West Coast. So, I mean, again, imagine that you're a guy that bought a quote unquote value add deal, right, at a low cap rate, with the intention of fixing it up and increasing the rents. And now, if this act passes, you're not going to be able to raise the rents. You got to keep the rents where they are. So what you've done is you've locked yourself into a crappy deal. So what's happening is people are cutting their losses heavily, and we're seeing the biggest capital migration from the West Coast to the East Coast in the history of our firm. And it's all in multifamily, and it's all multifamily owners that are trying to get away from all of that on the West Coast and come to an area that, look, I mean, most of the economic drivers in this country, if you want to look at it on a city level or anything, it's all, look, the East Coast drives our economy, and the West Coast spends the money. And West Coast is great for innovation and cool techie things and stuff, but I mean, look, we're the ones sitting out here grinding it, and I think the East Coast economy as a whole is in a phenomenal position right now. From a stability standpoint, from a growth standpoint, and also just from a general security standpoint. I mean, people want to be close to the hub of what they're doing. And the other caveat that I would have to that is, as you start finding these little gems of markets, it's amazing how quickly you can find that people are willing. I mean, people don't need to necessarily go to an office the way that they used to. So it becomes a quality of life thing. And, if you're, I mean, I'm a perfect example. I live in Leesburg, Virginia right now. Leesburg's, I don't know, 55 minutes on a good day. On a bad day, an hour and a half from my office. But, what I'm able to have out there is space and yard and things I can't get here. And when I go home, it's quiet. I have crickets. There's lightning bugs. It's nice. I'm a guy that's lived in the city his whole life. So for me, at this point in that's appealing to me. I also have the ability to work from wherever I want to. All I need is my cell phone and my computer. So, I don't come into the office every day anymore. And I think that, one of the benefits to these tertiary and secondary markets is, if you look at it from an affordability standpoint, what I have in Leesburg, if I were to try and put that inside the Beltway, you're talking millions of dollars. There's no way I'd be able to afford it. So, I'm kind of your perfect example of why areas like, Lancaster County is, as a crow flies, an hour and 10 minutes from downtown Baltimore. So if you're a guy who's, working downtown, making good money, but has a family and, doesn't really want to deal with the hustle and bustle of the city and, likes space and cows and Amish people, Lancaster is great.
Yeah, and just so in the community there alone, the jobs though between QVC and Target warehousing and guys, when he's talking about Lancaster County, that also includes that's greater Lancaster proper. So we're talking into York County as well, which we do have property as well. And I know we don't have slides today on York County, but Chris, if you could just highlight, because we have the single families and the duplexes, they've got rehabs there in Hanover area, which is in York County, which butts up right between the river. The two counties, and they're very, very similar, correct?
Yeah, I mean, if you're going to look at Hanover, York, and Lancaster, they're very similar. It's basically one continuation of the other.
Right.
York, you have a little bit more of an urban center in downtown, but Lancaster and Hanover are virtually the same.
Got it. So that being said, thank you for joining us, Chris. Anything that you can say? Well, I know you got a busy afternoon. Just in regards to most of our investors are I'll call moms and pops who they have a career, they have a job that they're doing, and you understand over our 8 years that our model is built for passivity, boots on the ground with the management company, and really, 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 safe properties, and it's no secret that our financing is bar none.
Yeah, that's a big part of the special sauce. But look, I am the first to say that even though I consider myself a seasoned veteran and like to think of myself as a pretty smart, savvy guy, I had when we first met and you started talking about self-directed IRA syndication and this and that, honestly, my ears shut off for the first couple times that we talked. Like, that sounds like, yeah, it sounds cool, but I don't get it. And as a guy that now owns self-directed products, and prior to really looking at this, I just maxed out my IRA. I maxed out my SEP IRA every year, so I didn't have to pay taxes on the money. I really wasn't looking at what it was doing, how it was, because I'm 36 years old. Retirement is not something that I'm thinking of right now. I'm thinking of, I don't want to pay taxes on this. So as long as I don't lose money, I'm fine. Like, it's a win, because prior to tax reform, 39.5 is a tough pill to swallow. So I think that in looking at the self-directed product, the exciting thing, or at least what I consider to be exciting, is, look, I get stocks to a certain degree, I get commodities to a certain, but I have no control over it. The nice thing about what you guys have and hopefully what we're able to provide in terms of inventory is it's good, solid bricks and mortar.
Right.
And you're going to have not only cash flow but appreciation. So when you look at it on an internal rate of return basis, you might say, oh yeah, I'm getting 4, 5, 6% a year in my in my investment fund or my IRA, whatever. But there's no appreciation in that over and above what the cash value of the asset is at that point in time. That's not the case here. I mean, we're setting a basis day one and then looking at, a potential transaction 6 years out. So having the internal rate of return of the bricks and mortar appreciation, I think, is especially attractive. And if you're getting predictable cash flow in a safe market that has been well vetted, I mean, that's a good retirement investment.
Absolutely. All right. Well, Chris, man, thank you so much. I'm sure I'll be talking to you later today. I know you got to get, but I appreciate it.
Tim, thank you, and thanks to all your folks, and we'll catch up soon.
All right. See you, Chris.
All right.
Have a great day.
Thanks.
All right. Investors who are on, I'm just going to go through a quick tutorial. I know that we've been on the call for a little bit, just about what Beckstone has to offer. Again, what Chris just spoke about. We buy in bulk. We're not looking for anything below C class, or excuse me, good B class property. And again, we know where the demand is. We know and share with our investors, where those assets are going to be. And Chris is off the call, but we go in there and underwrite and take our time. And it's not only us underwriting; it's Chris's team. It's our lender that's going to lend non-recourse on that product. It's our entire team, and I consider Marcus Millichap and Chris's team in DC part of our team. So what do we have to offer? Every one of the properties that we sell, every single one of them, is completely 100% tenanted with a corporate tenant. Okay, so there's a corporate tenant. You start cash flowing from day one, 100% occupancy. Another great thing is there's no deferred maintenance. Our lease takes care of that. So we have management on the ground, hired management, actually W-2 management. And the reason that is because if you can imagine, hiring contractors, waiting for them, if Mother Nature does something and they get busy, it gets hot, gets cold, storm, whatever it is, you could be waiting for days to get something fixed. And the funny thing about having tenants is tenants don't know that and they don't care, right? They want their item, they're paying rent. They'll hold the rent hostage and say, hey, I had a work order 3 weeks ago or 2 weeks ago and it's still not fulfilled. I'm not paying you rent. So we take that risk away and we cover any of those things, but we have W-2 employees. So we're not going for that bandwidth of hiring those expensive contractors based on their schedules to come out and assess and charge for that assessment and then, fix whatever it is. We do that right in house, and that's not a charge to investors. I don't know any other company that can tell you that. And our money. So, every investment with Beckstone, you're going to get 2.25 times the investment that you will get in the stock market. That's right, 2.25 times, okay? Average LTV, and it's not the same on every property, but it's 60% LTV at a handshake rate of 5% interest only, non-recourse. Non-recourse. If you're an investor that's not familiar with it, I would ask you to get familiar because it is the only kind of leverage that you can have within an IRA. You can't go get a conventional loan. You can't for the most part, go to your bank. And if it's a local bank, they might lend non-recourse to your IRA if you have a relationship, large deposits, and have done business with them before. You're going to see interest rates of 7.5% to 12%. The other avenue that some investors go that want to do this is they'll do hard money, which I think I don't need to dig into. It's named it for a reason. It's very expensive. So again, the market that we're in, Chris just attested to, is that greater Lancaster County. And another thing that we I'm going to hit on real quick is the Panama Canal expansion. When Chris was talking about Hampton Roads and what is happening in Hampton Roads with the Panama Canal expansion, we were in Hampton Roads in 2011, okay, prior to this expansion being built with Chris. We knew this was coming, and we knew that the only port is the port of Virginia that will be large enough, deep enough, wide enough. And right now it is functioning. This last month, I mean, it was delayed in a year and a half due to weather and some government stuff in Panama, but not here nor there. I could talk for days about shipping because that's been my life really since 2007, and I can talk to you guys individually about that. But what we're seeing here is this change in the way that America imports and exports. And if you can imagine this, Port of LA, Port of Long Beach, go look at the statistics. They've lost 20% of shipping year over year the last 2 years. And that's not because shipping is going away. It's shifted. Panama Canal in 1914 was built. It was built for a reason. It is a shortcut. Then again, right here we have a slide why the Port of Virginia. The Port of Virginia is the only port that is allowing these new ships. They're called Post-Panamax, Super-Panamax, and Neo-Panamax ships to come through. So what we've done with Chris and his team and our team here is we said, after we acquired and sold about 1,400 properties in that Hampton Roads area of Virginia, prices for our investors shot up. And then now rents are trailing in arrears and they're catching up, but our investors are into a great investment because of market timing. That's why Chris is on the call today, to try to give us a backbone to say, hey, what are the professionals doing? What are professionals from Wall Street, from LA? Why are they moving to this area? And again, that affordability matrix makes all the sense in the world, but it's only affordable due to jobs. So hydrocarbon gas and propane are huge, and that's actually an export, not an import for us. So what we're seeing here, especially with all the oil and propane coming out of that West Virginia region, as well as all around the Appalachian Mountains, what we're seeing is this huge need for fuel, and that fuel is being driven outbound out of the Port of Virginia to China, and as we all know, China being the exporter it is, they don't have the fuel, to make plastic. Plastic at the end of the day is petroleum, guys. So what has happened here is there's this huge shift that we're seeing, and we've seen it. We're too late to be in that Hampton Roads area right now, unless we do. We're constantly searching. I mean, Chris and I are on the phone all the time. But the cost to purchase there and the cost to invest there is going to be higher, right? The timing is still, it's like, okay, the Panama Canal expansion, when it opened in 1914, okay, you'd be investing in 1917. What would your money do today? Okay, so imagine that. And these aren't these are, what Chris was talking about, 5-6 years. And we have models that you can exit this in 3 to 5 years as well that we can speak of. But again, jobs are driving it. When I spoke about unemployment and what's happening in these markets, Greater Lancaster, just like Des Moines, Iowa, here where I'm sitting, looking at the Capitol out of my window, unemployment rate the same, size the same. Well, Indeed.com, it's INDEED. Look it up. Search Lancaster County, search Polk County. You're going to see the amount of jobs that are listed. Right now, a couple weeks ago when I checked, Greater Lancaster area, well, let me speak of Des Moines first. Des Moines area, 3,000 jobs posted on Indeed.com for the Greater Des Moines area. In the Greater Lancaster area, same size, same unemployment, 10,000 jobs. That's 3 times the amount. We're seeing rents increase right now. We have units at $1,250 that are now renting for $1,370. Okay, and that trend's only continuing to go up as we turn. And again, we spoke about tenants staying in property for more than a year. Our average tenants at our Longwood property have been there 3 years. And then here's the big deal: is trucking, imports, exports. You look right here at the Business Journal of Central Penn, speaking about Pennsylvania, the greater Lancaster area, just being fed these containers and these shipping that are then unloading at the warehousing facilities there, going outbound everywhere east of the Mississippi, even across the Mississippi to the west because of that lack. I mean, if you think about it, why can't they go to the west? The west sent to the east for how many years? Ladies and gentlemen, this is a shift. And if you don't act on it now, leverage that investment at 2.2 times, then we're going to be in a situation where you're going to be a coulda, woulda, shoulda investor. And I do not like to put any of our investors in a coulda, woulda situation. I see it. I hear it all the time. We hear things like, well, I looked this up on Zillow, or, well, I spoke to a friend who lives nearby there. Well, Zillow, there's nothing factual. You know, it's an algorithm. It's a guess who, guess what. Yes, they've got better over the last umpteen years, but at the end of the day, guys, Zillow is one of the best marketing platforms. I mean, Chris, who again no longer is on the call, but Zillow is being fed by really CoStar, which owns LoopNet, and which now owns apartments.com, and we've all seen Jeff Goldblum's bizarre commercials for them. I knew he was going to take that role well before it even happened, but you know, fundamentals, fundamentals, fundamentals. We are the professionals. We are boots on the ground. Here's a slide where I speak about Chris's team and his office, but of course, Chris let it off, thankfully. His whole team is just a wealth of knowledge. So just a quick recap, and then I'm just going to quickly go through some properties. What kind of assets do we purchase? Newer construction townhomes, and then gut rehab, single families, duplexes. That's kind of our bread and butter, is where that AMI is going to really, where the rubber meets the road, guys. And if you do want to be boots on the ground and go out and shop and compare and contrast, you're not going to find anybody with better assets, with better tenants, with employee management companies that have 5% interest-only financing as long as your funds are in the United States. And this goes for, we have buyers all the time, we call it inside-outside, that will buy property inside their self-directed IRA via a checkbook LLC, which we're 100% advocates for. Entrepreneurship, getting a checkbook LLC, having that corporation be your IRA. So you're then in control. You don't have to roll all your money, but then again, if you do have that checkbook control, you're one step ahead of the competition. Your fees are going to be less. Your reporting is done by us. It's a much easier situation. And we do have partners that do set up checkbook IRAs. And as long as you do business with Beckstone Partners, we will cover that cost at closing with a reimbursement. So if you think about it, you can get into the checkbook IRA, which is the cost of opening an account, which is pretty inexpensive with the partners that we do have. I will say that our organization does know all the custodians who do alternative assets, but we've been around the space long enough to know since 2007 in the self-directed space. There's some that are great, there's some that are good, there's some that are average. I'm not going to dog anyone, but service is key. This is your retirement account. If you've ever left a job where you had a 401k and you got a phone call from the provider of the retirement account for that job, and right here in Des Moines, Iowa, being the insurance capital of the world, the amount of retention support that is there via either Principal Financial Group or Wells Fargo, based here in Des Moines, you're going to see a lot of those retention phone calls made. And what that means is they're trying to keep their money. These people get paid to keep their money out of alternatives. Wall Street has us so soaking in the fact that we need stock, bonds, and mutual funds. Need is a terrible word when it becomes. There's certain necessities in real estate that are needs. But at the end of the day, stocks are not a necessity to life. where do you want your legacy? Where do you envision your legacy? I mean, we really look to Mitt Romney and how he has invested his retirement account. And if you Google Mitt Romney's self-directed IRA, if you like, we do have an ebook on it as well. But Mitt, all he did is invest in LLCs, his retirement accounts, and then he built these corporations based on this retirement account passively. Okay, it's 100% passive. He has assets that are built off of Bain, and I don't know the structure, and nobody really does, but where he has third-party administrators and third-party individuals running the companies, but again, he owns them. So when you're buying rental real estate in your IRA, you're running a company there. You're running a cash flow company, right? And then equity appreciation. So all of this is phenomenal. And then there's all kinds of exit strategies that were on that slide. We actually have new photos coming out here in the next couple of weeks. We have some drones coming in next week to the property because of course these pictures were taken in the fall while we were underwriting this. So this is actually an Marcus Millichap agent that was with us. These are photographs that he took when we were there at the property. But what you're seeing here is these townhomes. They're fee simple. They have basements, unfinished. Some actually have been finished off by prior tenants. But again, what you have there is a home, right? Out here in this area of the country, a row home is a very common home. Again, it's a colonial area of the country. You're going to see a lot of that in our gut rehabs, where the row houses, where our house sticks out. And I've had investors talk to me about it and say, well, it doesn't look good there. Well, you're not from there. And the whole scope of what neighborhoods look like, everybody knows which house is the rehabbed one. And that's where this whole Zillow play comes into effect. If I have a dilapidated home in a row house within a mile and a half that trades for, let's say, $80,000, and Beckstone has a gut rehab property that's retailing out at $150,000. Well, let's look at apples to apples, because it's apples to oranges. That property at $80,000 obviously is dilapidated. It's not rent ready. You're going to have to rehab it, get it up to code. These are historical properties, not this one on the screen right now, but our single families and our duplexes. So you're going to have, when you're talking properties 100 years old, you're of course going to have dilapidated ones, and then you're going to have your gut rehabs. And what we are is we're ahead of the curve, ladies and gentlemen. Building cost is going to continue to go up. So if you go out there and you want to play that Zillow game, looking at apples to oranges, it just doesn't make sense. Don't drain your energy, because at the end of the day, we have a lender that's putting up more than 50% of the asset non-recourse. So they're not pulling your credit. They're not underwriting you. They're not doing anything with you. Okay, as long as your money's in the United States, you qualify. So we have people that say, "Hey, I had a bankruptcy 5 years ago. I was late in the stock market, or not the stock market, the real estate market. I tried to hold as long as I could, and I had to exit in bankruptcy." But they still have careers, jobs, and a lot of people don't know. But with a self-directed IRA, that bankruptcy those funds aren't subject to that bankruptcy. So we have a lot of individuals who are business owners who take large losses in their businesses. Of course, that's the point. It's not the wealthy guy in the room that pays the most taxes. The most wealthy guy in the room is the one who pays no taxes. Okay, so always being involved in tax strategy, real estate. Just think about it. It's very simple. Listen to Chris. Think about what we spoke about. Think about the data here that we have, and you look at, this is exactly what Chris is talking about. You see the trend of down here. Down is good here, right? You see these deliveries, and you see this vacancy rate just continue to go down. So we're in the perfect time right now. We're at the bottom of a 7-year cycle in this. This is, like Chris attested to, this is an ancillary market that the shift of what we're going to see through any sort of bust out is take your money out of the stock market, put it in cash as quick as possible. That's my opinion, not a CPA. And I'm not a financial advisor or fiduciary. This is my opinion, but if we're getting that money out now, it's still at somewhat of a high, right? I know that we have certain clients, probably 20 of them I've spoke to, that are all kind of in the same situation, that were ready to do something but said, hey, I'm going to hold out for the market. Well, sometimes holding out for the market, or for a lot of people, isn't always the best answer. Sometimes the best answer is, let's pretend that that short-term 10% loss that I had never happened, because I never realized the money. That's the funny thing about the stock market. It's like a slot machine, right? Oh, but I was up 7,000. Now I'm down 5. I want to get back to 7. What's realistically going to happen is that 5,000 that you're at, if you stay in it and play that game, that could very easily turn into 3. And if you're climbing up a hill at 3, that's a lot bigger hill to climb up to get to 7 than 5, and switching your money, taking it out, buy low, sell high, people. It's very, very easy. So that being said, here's just a quick illustration. This particular property is a duplex. It's got rehab duplex property that we have. A lot of people say, hey, why are the moldings still there? In this area of the country, it is so important to keep the historical element of the property. You don't have to keep it all, but to have that there adds a whole different perception to the consumer when they come in. And then here's an example on Fulton. I'm assuming that you can probably guess that the one with the dormer on the top is ours, right? So you have these row home communities. This is where the millennials want to live. This is where that activity, the dining, and everything else happens. But you get a row house, which, heck, I'll take this all day. This is phenomenal what you get here. So you have consistency throughout our rehabs, keeping people employed. The mechanicals are very, very important to us every time. But again, we have no vacancy right now in our portfolio, whether we own it or our investors own it. So if you want to look into this and enlighten and enhance your portfolio, this is my direct email. It's BT Bravo Tango. The reason for that, a lot of people ask. So BT at beckstonepartners.com. Let us know if you want to swing by the office. We have investors fly into the office. I would say that 99% of our people buy these property sight unseen, and a lot of them get it. They say, I owned Apple stock and I never went to California to assess how they're doing. Well, this is a little different, right? It's a hard, tangible asset. And what we've always seen is investors, when it becomes real to them, because a lot of times if you're just okay with what your 401k provider's doing for you, which don't be okay, but if you are, that money's not real to you. But once you start to look at a real deal with cash flow and appreciation, all this happening, individuals seem to be more hesitant for some reason than a go-getter and strike the hammer. I mean, I have clients now that maybe at the beginning they were a little hesitant and saying, "Oh, I'm going to touch my toes." Okay, that's fine. Let's prove it to you. And then I have a lot of them, especially, almost every market that we've been in, come back and say, well, I want to buy another one. And it's a year later. And we'll either say they're gone, or what we'll say, they're gone. And if we didn't acquire more in this region, we didn't acquire more in this region. We've done business in 14 states and 40 cities. We're not stuck and tied to one individual market. It has to be the numbers and the fundamentals of the deal. And now those clients who are saying, oh, find me another one, I'll buy another one, and they're gone, of course, they're going into the next market with us. And, I had a client yesterday that went under contract on Monday, and he signed his closing documents. Title company got all the documents to him via DocuSign. All he's got to do is take a deed in person to get notarized. But send his money from his checkbook IRA to the title company. Heck, he's closing today on 2 properties. That sales cycle for him was about 5 days. He knows the metrics. He knows how, he's getting paid rent every month on the 20th of the month. He knows he's cash flowing from day one. And he's excited because he knows what it's done for him. And, does he still diversify? Absolutely. Absolutely. And when you become clients of Beckstone Partners, there is other diversification plays that you do open up to. We do some really cool. They're a little longer terms than, we don't call them fix and flips. They're fix, improve, live, and flip, because the greater investment is sometimes is that 2 to 3 years play when you purchase the kind of houses that we do, and that's called our net income generator projects. But those are for clients of ours that we've done business with and know. But the return wise, what we're talking about, internal rates of return and rents, you're in your the newer construction stuff, you're in your low 7s. That's just cash on cash, and your single families will be in the 9s. But then you take into account what we're seeing in this market, 7% appreciation growth, and you take in, $80,000 out of stocks, bonds, and mutual funds, and converting it to a $220,000 property that's worth today, $240,000. You're inheriting equity, as well as you're getting an appreciation off the market price, not what you paid for it. So imagine this: instead of looking at your account and seeing $80,000 there, you have an asset that's worth $250,000. It's very simple, and that's what you get with Beckstone Partners. It is worth your time to get a phone call in to us. Send me an email, schedule a call with myself or my team. More likely it'll be with my team because we're so extremely busy here, but they're well versed, and I will speak to you as well about this and what it's going to do for you. But ladies and gentlemen, I can't be more excited for this market. I can't be more excited for our investors who have already acted on this and made a move. And I would highly recommend it, not only because we're doing business there and we're the only company like this in the country right now that has such a product. We are unique. We are alternative, but this is what we live and breathe. We are emerging market experts. So with that, I'll leave you to a good day, good evening, good morning, since we do have investors on this actually from all over the world. Thank you very much. And again, my contact info is right here. Call the main line at 515-414-8794. You can email me at bt@Beckstone Partners, or simply just go to our website. Thank you very, very, very much for this webinar here, June 2019. Appreciate it, folks. Have a great day. Bye-bye.